Let's take a check on futures this morning. The markets indicated to open lower on Wall Street, but just a hair. Markets closing at 1 p.m. Eastern time today for Christmas Eve. Bond markets will be closing at 2 p.m. Both equity and bond markets close tomorrow for Christmas Day. Investors watching for a potential Santa Claus rally, the traditional year-end surge spanning the final trading days of December into the first days of January. Markets also notching strong gains this year, led by an AI-powered rally. The Nasdaq was up 22%. The S&P 500 up 17%. The Dow up 14%. Meanwhile, Intel shares sliding a little bit after reports that NVIDIA is halting tests on the company's 18A manufacturing process. Joining me now, Morgan Stanley Senior Vice President of Investments, Jim Lacamp. Jim, it's great to see you this morning. Thank you for being here. You say that the bull market still has room to run, even if things get a little bit choppier next year. Walk us through your outlook, and what's your take on AI and the spending cycle?
Yeah, so the market still looks really good here, Jackie. And while the first part of this year seemed more like a rodeo bull market, meaning it was harder to stay on this bull. We had a lot of cross currents, the tariffs in, tariffs out, a lot of conflicting news on the economy. Now it's more like a pasture bull because everything seems to be lining up well for this market. We have CapEx spending plans really strong, which does go to the AI question, and we'll come back to that. But we have the Fed that is in a rate cutting cycle. Looks like the Fed funds futures are suggesting more cuts still in next year. We have productivity rising. Consumer spending is still very strong. Consumer incomes are outpacing the inflation rate. So and earnings are continuing to rise and pointing north. So we have a set of conditions that's almost ideal for a stock market. Yes, valuations are high, and so that might imply that we will be a little choppy next year. The second year of the presidential cycle is usually choppier, but we have a lot of things coming from the tax bill that could help the market next year. So I think investors have to stay constructive here. And yes, if you look at the semiconductors, the AI spend still looks intact. You looked at Micron's earnings statements and what the semis have done since then. It looks like a new leg is afoot here.
All right, let's take a look at yields this morning. The yield on the 10-year Treasury was bouncing around in the same territory that it's been for the last few days, 4.166%. It's down 0.1 basis points this morning. The economy expanding at its fastest pace in 2 years. That was the big news in the third quarter, bolstered by resilient consumer and business spending. President Trump says he expects the next Fed chair to lower interest rates when markets are doing well, arguing that economic news shouldn't trigger rate hikes or market sell-offs. Fed chair contender Kevin Hassett says the U.S. is way behind the curve on cutting rates due to stronger third quarter growth and the AI boom, cooling inflation while boosting the economy at the same time. Meanwhile, Treasury Secretary Scott Bessent floating the idea of revamping the Fed's 2% inflation target once inflation sustainably reaches that level. Bessent also says stabilizing the budget deficit could help justify lower rates. Jim, what's your outlook on the path for rate cuts next year, keeping in mind that Jerome Powell will be out in May?
Yeah, so I think this is the most important question for the market for next year is rates, and inflation is 1B there. The reason rates are so important here, Jackie, is because when you look at the private equity markets, and far more companies are private than public these days, they rely on debt. And if interest rates remain fairly high, and on the longer side, they have remained fairly high. You pointed to the 10-year Treasury. That really hasn't moved at all. The private equity markets really need those rates to come down to really shine. And not only that, the housing market is reliant on rates coming down. Mortgage rates have come down just a bit, but they need to come down a lot more, particularly with the inventory issues that we have on housing. So some of the drivers of economic recovery really rely on rates to come down, and that's usually why economic recoveries start. And if we don't see that, if inflation remains too high, if the tariffs continue to keep inflation at a rate that is not conducive to rates falling, then that could put a little bit of a damper on the market next year. I think that's one of the things we really need to watch. But oil prices are low, Energy prices are low, and I do think rates have room to come down a little bit. So we'll see if the market agrees. We have a lot of treasuries that we have to issue and we have to find buyers for. The 2-year auction this week didn't go so well. So we still have debt to sell, and we need to sell that debt. So that's going to be an important question for next year.
Sure, and I'll just underscore that inflation could potentially bounce around where it is at this 2.7% level. If that does remain in check and the labor market is a little softer, the Fed could focus on that and really make a case to cut. So we will see what the new year holds in store for us. Jim, it's always great to see you. Thank you so much for being here.
Good to see you, Jackie.
Thank you.